Hey guys, Dan Matheson here with K2 Tax Group. I want to go through just a scenario that we often see some of our clients. Before they become clients, what happens is we take a look at their tax return and compare it to what they're actually allowed to deduct, and the results are astounding. It's really not uncommon for us to have our clients save 20 to 40 to 100, sometimes $200,000 or more per year in taxes. And basically, it's a matter of being proactive. Too often, what happens is that you take your information at the end of the year and you simply give it to your tax preparer. And you're thinking that their job is to help save you money in taxes. That's not what you're paying them for. What they're doing is they're preparing a compliant tax return. They're taking your information and they're putting it into the tax return correctly, but there's no strategy behind it. When we are proactive with our strategies and we set things up ahead of time, it's not uncommon for somebody to save 20, 40, 60, 80, maybe even up to $200,000 per year. And there's some very common things that are overlooked. And let me just share with you a couple of my top 3 or 4 ideas on how to save money in taxes. Number one, are you structured properly? Meaning, is your tax structure, is it a C corporation, an S corporation, or are you just simply filing as a Schedule C? That would be one of the first things that we take a look at. The next thing are, do you have children that you can hire and shift income from a higher tax bracket to a low or no tax bracket with some of your children? Number 3, if you've got a business, did you know that you're allowed to, that business is allowed to rent the home for up to 14 days per year? The business gets a tax deduction, but you do not have to claim that income as income. So even though your business is paying you personally to rent the house, you do not have to turn around and report that income as income from the rental of that house. Now, there's some rules to follow, and we can do that only up to 14 days, but it's tremendous tax savings. The other one that I see very, very common is that too often people are using a 401k or solo 401k or IRAs without tapping into a much larger tax deduction like a pension plan. 401ks are great to a certain point, but they only allow you to put a certain amount in. It's very common for some of our clients to put in $200,000, $300,000, $400,000 per year into a tax sheltered account and get a tax deduction on $200,000, $300,000, or $400,000. Imagine what that tax savings would do for you. And it's just a matter of you being aware of what the tax code allows. The problem you have is that you don't know what you don't know. And your CPA or current tax professional probably doesn't know everything that's available to you. But once you unlock the power of the tax code, it'll work in your favor and you'll save taxes big time.